Hello. So we may have witnessed what ends up amounting to be the very first pop of the tech bubble. Technology is clearly in a bubble, just in terms of the movement that we've seen through the whole pandemic crisis and lows and things of that nature. So there are a lot of interesting things that are happening right now in terms of the transitions that are happening internally within the market. So I often talk about how phase transitions are one of the hardest things to trade around or the hardest things to invest through, especially when you're going from a phase transition of potential inflationary to disinflationary or even deflationary. Those are two very different things, and they bring about a very different portfolio structure that needs to be in place. And so this week there were a lot of interesting things happening, not the least of which were volatility measures kind of across the board. Uh, we're watching a number of things right now. Everything is very, very tightly tied to what happens to both the dollar and to oil. And both are pretty much on a precipice right now of a fairly dramatic change that if a few things occur, and they're not far away from potentially occurring, but if they occur, then that would start to signal what we would refer to as a quad four environment. And quad four is where you have slowing growth with deceleration of inflation, or in other words, deflation. And deflation is just straight up death for risk assets in general. There's only a few things that work decent in that type of an environment. Longer dated treasuries and gold being two of them. Silver would probably fit in that capacity, but that can potentially be a risky asset. The most recent example of what a deflationary quad four type of an environment would look like was February and March into the early portions of April. And so we all saw what happened with risk-based assets during that time, and that's not a fun environment. So let me share my screens with you on this quick video, just to give you some glimpses into what I'm looking at and what I'm thinking about and why, and hopefully it'll make a little bit more sense in terms of what I'm trying to explain. So this is a picture of the VIX, which, as you know, is the volatility measurement for the S&P 500. Trend currently for the VIX is at 26, so right about in this range here. All that means is that if VIX stays north of 26, while at the same time the volatility measurement for the NASDAQ stays above 32, we have a situation where that's chronically elevated volatility. And whenever you have chronically elevated volatility, you have an environment that is very difficult in general for equities to do well in. And it doesn't matter what kind of equity. So, we've been talking about being in quad three, stagflationary type of an environment where we have slowing growth but yet accelerating inflation. And I've showed a number of times how that accelerating inflation has been manifesting itself in the various forms of commodity-based assets, both softs and hards, agriculturals, metals, right on through to the way in which the dollar is responding. The only two quadrants and there's four quads, right? Quad one, quad two, quad three, quad four. Quad one is a Goldilocks environment where you have accelerating growth and decelerating inflation, which is, good across the board. Quad two is accelerating growth and accelerating inflation, but yet under check. Quad 3 is where you have slowing growth and accelerating inflation. Deep quad 3 is one of the worst of those kinds of environments where the inflation is happening very, very rapidly, where the growth component in terms of earnings and sales are dramatically stopping or slowing down to potentially stopping like it did during the lockdown phase. And then quad 4 where everything's just trash. It's just deflation's not a fun environment. And so we've been in this quad 3 environment with accelerating inflation that's been very easy to see. You can see it when you go grocery shopping and things of that nature. And the growth component of earnings and sales, for the most part, with the exception of a few components, have been not great. When the dollar starts to give you signals that it's changing, it starts to give you signals that potentially there's a phase transition in the economic structure. The only two times that the dollar goes up in any of the economic quadrants that I just talked about is a deep quad 3 or a quad 4. Those are the only two times that we see the US dollar accelerate in value. Every other time, it's dollar down, right? So because of that, what we have to do is pay very close attention to what the dollar is doing, right? And so if we take a quick look at a representation of how the dollar has traded, this is just a picture of the dollar as expressed through an exchange traded fund, symbol UUP. Nevertheless, you can see that it's still been a dollar down environment, right? A decelerating or deflating dollar. However, the dollar has what we call a trade resistance, and we'd have to look at DXY for this. DXY is the actual dollar index. And when you look at the dollar index, what we have to watch for are certain levels. The trade level for the dollar index is 93.72. So if it breaks above that, that's short-term bearish for almost every other asset class, because there's an inverse dollar correlation currently with the S&P, with oil, with commodities in general, and with gold, right? If it breaks above trend resistance, and trend resistance for the US dollar as represented through the index DXY is 96.05. If it broke above 96.05 and at the same time oil broke down below 37.13 and they both stayed there, while at the same time VIX stayed above 26 and VIXN, which again is the Nasdaq's volatility measurement, stayed above 32, that spells a bad juju. That's not a good place to be in terms of the economic structure moving from a stagflationary environment into quad 4 deflation, which is where we would become extremely protective of all asset classes. So this week has been a very interesting week in that we saw the dollar collapse on Thursday, and then intraday did a snap turnaround and went right towards the high end of the mathematical range of expected movement on the day. And it was during Thursday, during that movement of the dollar, where I started to rapidly de-risk a lot of the commodity holdings that we had, and still hold small positions in several, but also de-risked in terms of some of the international exposure we had with Norway and Finland, de-risked in terms of the oil movement. Now, who would have predicted that the Saudis would come out last weekend and cut oil? You can't predict that sort of stuff. So you have a process for A/B testing any asset class that you want to be in. Test A, what quad are we in, which gives us the economic structure. Test B is what's the quantamental, as it's called. What is the technical signal that is allowing us to either enter into that particular position or exit from that particular position? And that quantamental structure, that technical signal, comes all from a structured math component that helps us to identify the probable range of movement of an asset class in a particular day. And it's all a function of calculating price, volume, and volatility, with volatility being the primary component of that situation. That's the primary driver. When volatility regimes this past week really started to break out into an uncomfortable area, I mean, you can see what happens to stock markets when VIX goes north of 30. Let me just share that with you real quick. So here's the S&P 500, and obviously we've got, a market that's off roughly 10% inside of a week's worth of trading, which is, a fairly considerable movement in that short span of a time. But you can see how in the beginning stages there was a lot of volatility here. Well, let's compare that to what it looked like with VIX. And you can see the first day that it really blew out was here on Thursday the 3rd, and it was up above 30. And the next day stayed pretty much above 30. The next day it was above 30 again, right? So you had these 3 days, September 3rd, right, which is here, 4th, and 5th. So on those 3 days trading alone, market was off about 7% total. So you can see when VIX breaks north of 30, lots of bad things can happen really fast in equity space. So what do we need right now? We need some time and we need some space to be able to develop whether or not there is a phase transition happening within the economic cycle. If a phase transition is to happen within the economic cycle, it's going to show up in the dollar, and it's going to show up in the value of oil. Now, today, oil is acting okay. It's not acting amazing, but one of the things that we look at is oil volatility. And this here is what we would call episodic cluster of oil, oil volatility. This is an episodic and trending base. It could trending down. So, oil was an environment that was safe to be in, and then all of a sudden, bam, a quick spike. And you can see the representation of what that did. That spike in volatility did this, and it was brought about by the announcement of the Saudis that they are going to start cutting oil price or production rather, which obviously has an effect on oil pricing and changing the perspective on how this whole thing might play out. But nevertheless, I don't care about what one country says or what one country does. I don't care about what Saudis do or don't do. I don't care about what Venezuela does or doesn't do. What I care about is the mathematical probability and how it fits into my process. There is a very strong discipline and a very strong process to what I do and how I do it, as you know. And so what I'm careful of is whether or not the math is telling me to do something different. Currently, in this past week, the math was saying de-risk. And so therefore, as much as I hated to unwind some of the oil position that I had built up, I felt it was necessary because when oil volatility was spiking, like it was, and again, let me share that with you real quick. So symbol OVX is the oil volatility measurement. When this volatility measurement started to spike like this and then slowly come back, one of the things that we had to watch for was 54 on this level. Now, it's closed below 54. It stayed below 54 so far today on Friday, while at the same time, oil prices in general are down slightly to slightly up, and it's just not a lot of movement in that market right now, but it's staying above the current price level that we needed. So let me just double check oil price as long as I'm doing today's video so we can get a glimpse into the exact price and time. So it's currently 12:12 p.m. on Friday, September the 11th, and oil currently is trading at 37.60, up 0.8%, almost 1%. So therefore, you get some movement upwards in the representation of that commodity through the ETF BNO, which is what we own. And at the same time, as you can see, the volatility measurement has come down slightly, but you can see it was down a lot harder earlier today, and now it's creeping up. What we don't want to see is oil volatility increase, while at the same time, price on oil decreases below that trend level that I mentioned of 37.13. And so far, so good. It's at 37.60, 37.59. Obviously, it changes by the second. If we can stay above 37.13, if oil volatility can stay below 54, if the VIX can stay below 26 and the VIXN below 32, which both of those are not there yet, and the dollar stays below at least 30.72 and moves itself down, lots of asset classes will work great. But as I said, this week was sort of a transition week, and there were a lot of very negative feedback elements coming into the math based on the movement of volatility. And that volatility was very relevant and very obvious in the way in which the NASDAQ top performers were playing out. Volatility in names like Apple, Google, Amazon, Microsoft, Tesla were off the charts and still are incredibly elevated. So when you have the biggest names that represent the largest components within most of the indexes and lots of space in most institutional portfolios, along with lots of space in the mutual fund world, when you see their volatility measurements increasing while prices increase, that's not a good scenario. That's where bad stuff can happen. And so it made sense to work towards protecting the portfolio right now in the midst of a potential phase transition. If we transition from quad 3 to quad 4, I absolutely want to be protective. It's all about protecting the portfolio, right? We can take advantage of growth once we get solidly within a growth component of a quadrant, either 1 or 2, or we're solidly back into quad 3 where it easily is able to identify an inflationary environment as it relates to most commodities. So I've taken most of our commodity holdings down into a very small position. I got rid of some of the emerging market exposure that we had that were in quad 1 or quad 2 themselves, like Finland, Norway, got rid of Russia. Russia was not playing well in the sandbox. Its volatility component really got out of control. And all of that is a function of what was going on with oil. And as is the case with anything, you never worry about the hand you just got done playing. You deal with the hand you've got and you worry about the next hand you're going to play. And that's how the market works. We deal on a macro basis, which means we're looking at all things, not just the myopic world of stocks. It's everything. Rates, commodities, currencies, all these things work together to figure out how to best protect portfolios in the midst of a volatile and yet transitioning environment. And so therefore, that's what we're looking for. We're looking for a phase transition from quad 3 to quad 4. It hasn't happened yet, so I'm not positioning the portfolio for that. I'm just preparing for the possibility, as the probability is about 40%, so it's not immaterial. It'll be identified based on what happens with the dollar number one and with oil number two. And so far today, the way in which both of those are trading, we're fine. Oil above 37.13, the dollar below 93.72, and trending. And so therefore, that's one of the reasons why I also haven't taken really many positions in the equity market here to date. I've unloaded in utilities. I've lessened our exposure to real estate. I got rid of the tech that we owned. And I did that simply because all the volatility measurements for equities, VIX and VIXIN, were really getting out of control, right? As I showed you, the explosion in that volatility that was taking place. One of the things that does happen when you start to go into a deflationary or disinflationary environment is a function of how the Fed is dealing with that, right? And so one of the things that we have to recognize is that the Fed came to the table in March with a huge gun, and they really let it rip. They put a lot of money into the system. They printed it like crazy, which has obviously had a negative effect on the entire dollar itself. But since then, essentially since June, we've really not had any movement in the Fed's balance sheet at all. And I can show you a quick representation of that here. Let me just do this. Bear with me one sec. This is a quick picture of the Fed's balance sheet from the beginning of the year. So you can see it zoomed up here and has basically been flat since June. And the reason why that's important and valuable is that equity markets take a lot of cues from what the Fed's balance sheet is or isn't doing. So, with VIX and VIXIN in an elevated environment with it above a trend level that would cause typical problems for equity markets, I want to be very cautious there, because elevated VIX even hurts things that do well in deep quad 3 like utilities. So everything has to be kept on a very short leash, and as you've noticed, I've done my best to do that. I think through today, equity markets, as represented by the NASDAQ, down almost 10%. I think we might be off maybe 1.5% from the highs. So I'm never happy about seeing a portfolio pull back a little bit, but at the same time, we're ready to take advantage of the next phase, whichever it might be. It might be back into quad 3, might be in quad 4. Either way, I'm ready and set to take advantage of that when it happens. And I'm going to keep a close eye on those things that I've mentioned. So at any rate, just a quick update on where things are at. If you have any questions at all, please let me know. Emails are great. Phone calls are awesome. Always love to hear from you. There's no such thing as a silly question. Direct line 608-354-1977. Email chris@careformywealth.com. And with that, thank you so much for your time. Thanks for the continued opportunity to work for you. I appreciate it. Blessings on your weekend. See you.